Well, thanks for tuning in to Bloomberg Quint. This is the Mutual Fund Show. Every Wednesday at 12:30, you have your appointment with me. Tell you about what you should keep in mind while investing in mutual funds. All may not be hunky-dory all the time. How should you prepare yourself for that? And don't follow past performances because they need not be a right indicator of what the fund will do in the future. And I think that's the message that is coming in from Tarun Birani. He's the founder and CEO of TBNG Capital Advisors. Tarun, good having you. Thanks so much for being with us on the Mutual Fund Show. Now, I was looking at your views, and you believe that expecting returns based on past performance can lead to a lot of accidents. Would you give us an example of why you mean this?
I can just see a very clear pattern of herd mentality, wherein investing happens just because there is a change in the market currently. I was just going through a quick number check, wherein anybody who would have invested with these behavior bias of herd mentality in last 10 years, taking out money, taking in money and all that, his CAGR return was approximately 10%.
Okay.
And somebody investing with a regular investing with this 10-year time frame with all these things, his CAGR was around 14.5%. Right. So we are talking about a 4.5% CAGR. And I'm sure you know what is the kind of money they have lost.
Right.
This is one accident. Apart from that, we have seen investors who are more opportunistic in nature, who just because a friend told, just because Neeraj told, a news anchor told, he would buy, right?
Right.
He has not done his goal part of it, right?
Right.
So, which is again, I see that as a very big problem. What Neeraj requirement is, what Tarun requirement is completely different, right?
Sure.
It's like sitting in a cab and you don't know which way to go, right? You're telling the driver, take me anywhere you want. And I think that's where I see most of the investors, they are clueless what they want. I feel this whole financial planning discussion or this investing discussion should more focused on the individual goals and need. Everything else can be taken care of.
This show is also aimed in a large part towards people who want to get an entry into mutual funds.
Sure.
And are thinking about what kind of fund should they choose right now, what houses, what schemes. So what would your advice be?
So again, Neeraj, there is no one fit all solution. It's a very, very specialized, customized approach, and I don't feel we can look at just recommending anything or anything to anyone. So they need to do their the basic risk profiling part, wherein I have seen people with a 35-year age bracket also are in a very low risk bracket. It is because their parents have always been very low risk investor. Their financial situation had not been that great. That makes them very...
By low risk, you mean keeping money in fixed deposit?
Fixed deposit accounts, or 10-20% maximum risk profile. So we had such cases wherein a very high salary bracket guys also in 35 age bracket, their risk profiling was very low.
Sure. You think that shouldn't be the case?
Yeah, that was not the case. That was, as an advisor, my perception was, but that individual can't take risk. So I can't generalize, right? So I can't generalize. That's where my whole argument is, we just can't generalize. But yes, for a first time investor who has a 5 to 10 year time frame looking at today's specific market, I would rather go in a hybrid or a balanced category.
Why?
Big reason for that is it gives you a growth with stability. These are the two important markers of a balanced fund. If you look at the standard deviation of a balanced fund compared to a normal equity fund, it is approximately half of that. But if you look at 10-year, 20-year returns, they have delivered approximately 15 to 17% CAGR. So that makes me very comfortable, a tax-free return, low volatility, falling less than market, and gives you growth. I think what else?
Looking at the current market juncture, is balanced funds still a better bet, or would you tell them, without getting into names of the funds, would you tell them to get into maybe pure play equity funds or multi-cap funds or otherwise? Yeah,
so when this discussion moves on more customization and where the risk appetite is there, I think we will look at strategies like a pharma and a tech space, which last 1 year has actually underperformed.
Yeah, thematic funds.
Thematic. We could actually look at such strategies. Infrastructure is one play which more and more looking good from next 3 year point of view. So I think these are the plays we could look at, somebody who is looking at a high risk. Yeah.
Tarun, thank you so much for being a part of the Mutual Fund Show and giving us your thoughts.